Mortgage fans. So back for another market update. This time I've labelled it up and away with a question mark, because what we're going to look at is the base rate has obviously gone up, inflation's gone up, and it looks like the London market might even start to get away as well. So let's see how that breaks down this week. Before we get into that, I was just quite curious. Now we're at the end of dry January. Hopefully you're celebrating suitably this weekend, Six Nations as well. So good excuse to fully shake off January. And I was also then wondering how many New Year's resolutions are still in place. For any avid listeners, I've said at the beginning part of the year I was going to meditate, exercise, and read for a minimum of 20 minutes each a day. And I'm very proud to say I've stuck to that. So I wonder if your things are sort of still sticking that way as well, because that's had a really positive influence for me. So sometimes some of them stick. The not drinking thing, I won't lie. Not been great on that, although I did morph it into I don't want to get drunk this year, which is already still seeming ambitious. And I was actually at my first conference this week in like 2 years, and yeah, some people making up for lost time there. So if you haven't been to a group event post lockdown, it gets wild. So enjoy that. But anyway, far more importantly, let's look at the big news of the week. The really, really big one is the Bank of England raised interest rates, moving up from 0.25% to 0.5%. So that's primarily what the title of the update is about. So rates are going up. And what does that mean for mortgages and mortgage products? So any, again, regular listener will know that I have been talking about this for a while now. Mortgage products already moved ahead of the Bank of England moving their rates. So in the mortgage world, not really too much has happened. Naturally, variable rates will move. So they are the ones that you'll see the direct movements. So if anyone had a base rate mortgage, that will now be 0.25% higher than it was. And this comes with my classic risk warning whenever interest rates rise. So, and I'll touch on this at the end, how it works in a practical sense with the best rates. But what you can get caught out with in this period is something called discounted products. So there's two types of variable products: a fixed and tracker rate and also a discounted rate. Now the tracker is typically linked to the Bank of England, so you'll see immediate changes there. A discount is linked to the lender's own standard variable rate. Now most banks don't raise their variable rate until maybe a month after the Bank of England does. So guess what's top of the best buy table was this week? Sneak preview, and I'll talk about that in a bit more detail there. So if you are looking at a variable rate product, if you are looking at the cheapest products on the market, beware. Many of them are discounts, and what you might find is those rates will increase next month when actually the base rate went up this month. I have talked about that length previously, but just please be aware of that dynamic. Now, again, another point which I'm going to dive into in a bit of detail, because this one really going to be thinking as well, because in the context of mortgage rates going up and the base rate will continue to rise this year, again, see last week's update on that one. What we are seeing is a bit of a split in how mortgage lenders are treating the market. So what banks are really keen to do, or seem to be keen to do anyway, is deal with higher net worth clients, higher earners. That's what they're really after. Because a bank came out today, I think it was Thursday, forgive me, where they're now lending up to 90% of property of £1 million, which is quite rare. Normally, only sort of private banks or more sort of bespoke lenders do that, but this is quite a mainstream provider. So, sort of think, well, why is that? I like to sort of connect the dots where I can. And there's a sort of logical outcome of this, and it's the other thing I've alluded to in the update, which is there's now a big affordability squeeze. So I saw an update from Andrew Bailey, who's the head of the Bank of England, who was actually warning against pay rises at the moment, because a lot of people do their annual sort of appraisals this time of year, and he was saying employers shouldn't be raising salaries, which as an employer I wholeheartedly support. No, joking aside, you know, it's a really complicated one. It's very difficult because in the Bank of England's own forecast, they think inflation is going to top out at 7.25% in April. That's mental. Like, we haven't seen that. I mean, I can't ever remember seeing inflation at that level. Obviously, we've been there before, but probably not in my lifetime. So what the point he's trying to make is the Bank of England are going to raise interest rates that will bring inflation down. But then if people get high salary rises, that will actually have a longer, more sustained impact on inflation. So it's a really, really tricky one. So that's the backdrop. So what that means is there's a real affordability squeeze on normal household incomes. Everyone knows about energy prices, etc. I don't need to talk about it in too much detail. But what I did want to do is just pull out a really specific example as to why banks are more likely to deal with higher earners than not. So the way that we work in mortgages is we work on affordability basis, and we look at things like net income, about how to sort of distinguish how much someone can borrow, how much should someone borrow. And what I've done is just put these price rises in context as to what it means in different salary brackets. So just picking a theoretical example. If, say, for example, after your mortgage, after your bills, every single sort of direct debit that comes out of your account, if you're left with £500 a month to then buy all your food and your energy, etc., what you might find is broadly energy prices and food prices might mean that your bills are now 100%, sorry, £100 a month more expensive. Now, if your net pay is 500 and your costs go up by £100, that is a 25% reduction in your net income. That is massive. So you can't overlook that. However, if your net income is £5,000 a month, those increases are still broadly true. It's still roughly about £100 more, probably a bit more to allow for bigger properties, etc. But things like food and stuff, a lot of that is optional, so you don't really feel it as much. So in that very same example, if there's a £100 increase on a net income of £5,000 a month, that's only a 2% reduction in your net income. You're not really going to feel that. What you might do is go to Sainsbury's rather than Waitrose, or not go away for the weekend. That's the sort of lifestyle choices you make, and it's not really affecting you. However, if you are on a lower fixed income, that's a massive hit. Really interesting piece of work was done by a lady called Jack Monroe, and it's a lady called Jack, so look her up. Very prevalent on Twitter, I believe. I don't actually have a Twitter account, but that's how she sort of became sort of quite well known. She's done a lot of really interesting research on lower earners and lower incomes and how much it affects price rises. So the Bank of England think inflation will go up at over 7% this year. Her research points to prices going up by 50 or 100% in more cases. So what she looks at is things like, the Tesco's Basics pasta, or like, the own brand rice, that sort of stuff. A lot of that was sort of going up from sort of being 29p a bag to £1 a bag, so that is massive. Massive, massive. So this affordability squeeze is really going to be felt at the lower end of earners, and banks do have to take that into account when they think about how much they're going to lend you. And then ultimately, why I think banks are now big of a flight toward higher earners, which then pushes me into that next point about where house prices are going, and is this maybe a turning point for the London market? For a couple of years now, we're seeing sort of headlines of national house price rises, breaking records, all that sort of stuff. But if you live in London and the southeast, you're probably looking around thinking, I don't know where that is. Maybe not the southeast, because there's been quite an outflow into the home counties, but certainly London, arguably house prices are flat since 2016. So a couple of things that caught my eye this week were Rightmove, which is one of the biggest property portals out there. They had a record-breaking January. They had 218 million visits, which is up 44% on January 20, which is the year before the pandemic hit, which is really interesting. Buyer demand is also up 24% also as well. Valuation requests to agents are up 27%. Property Mark, which is another property website, says buyer demand is at a 17-year high. So it's really, really clear there's loads of people active out in the market. Now, Nationwide says that nationally house prices have gone up 11.2% from this January to the January previous. Now, what Nationwide are really good at, they break it down regionally, and London is the lowest performing region. House prices are only really moving up 4 or 5% in that time. So put these things together. Banks are really happy to lend to higher earners. There's a sort of real depression in London prices, which means probably it's a fantastic time to buy. So are these the conditions in which we see London actually start then picking up where it's been lagging really since 2016? I personally think so. So that's the point to the headline of getting away. Is the London market going to get away from you? So if you're in a position to buy, looking to buy for the first time, please do explore London, because it's way cheaper than you think and your money might go farther. But I don't think it's going to last. And that's the point. I think by this time next year, I don't think you're going to see 4 or 5% growth in London. It could be much more. We don't know where the future goes. Everything since 2016, ironically, has taught us that. Or in fact, if anyone's read anything about history, the future is never what you think it to be. People think the future is a slight moderation of the past, whereas in reality, it's normally wildly quite different. But all things being equal, that's what I think we're headed for this year. So if we break this into then how that translates into money market rates and mortgage rates. So market rates, you won't be surprised to learn, all up last week off the back of the base rate rise as well. 5-year money's at 1.3%. That's up 0.02 on the week previous. 2-year money is up to 1.28%, which is up 0.03% on the week previous. 3-month sterling LIBOR is up to 0.654%, which is up 0.044%, and the Bank of England obviously moved rates up by 0.25%, up to 0.5% from 0.25 the month prior. That information is provided by the ice.com and globalrates.com. And how that translates into best rates then. So as I alluded to at the start then, the best rate on the market right now is 1.04. However, big risk warning, that is a discount product from Accord. If you're looking on Best Buy tables online, Accord is the intermediary brand of Yorkshire Building Society, so they normally mirror each other's products. So you might see Yorkshire top of the charts there. They have not raised their base rate. So there are tracker rates that are better than that. So I'm not going to do that to death now, but big risk warning on that one. 2-year money is the same as last week, which really bolsters my point that mortgage rates have already moved, and they're at 1.29%. 5-year money's at 1.44, which is up marginally, and buy-to-let rate still holding at 0.99%. That's actually a product with a massive fee, so probably not a great option for many people, but it is keeping very low rates out there. Again, usual sort of caveat I put into all of this, the rate you'll actually be offered is dependent on your personal circumstances and deposit. Those rates I just gave are for the very best markets, very best rates on the market. So if you've got a large deposit of 40% plus, and plus a very straightforward situation, you may well achieve that. If your deposit is smaller or your situation is more complex, you may well pay a lot more than that, but that is the starting point. So that's it for this week. Hope you enjoyed the update and look forward to catching up with you next week.